Good day, fellow investors. As promised, today we'll talk about a great business and what does it mean to invest in great businesses. The topic will, of course, be Google. On Tuesday, I made a video discussing Li Lu's most recent interview, summarizing it, and he said that investing is about investing in great businesses, which means high return on invested capital, high profits on your investments, then a moat, which means that competitors can't really take your market away, can't take away that profitability. And then he also is looking for a long runway so that the business can keep compounding over the long term. Google has all of that: a moat, high returns on invested capital, profitability, and a longer runway, especially if some of those, let's say, bets that they say develop well. But also, if we look at the stock price since the IPO in 2004, and I remember in 2004 on our local forum, somebody said, well, Google is a strong buy, just buy that stock and forget it. Of course, now, 16 years later, the stock is, what, a 40-something bagger, almost a 50 bagger, and there is still a lot of potential. But Li Lu also said that we should watch many of those great businesses, learn them, know about them, and understand them so that when those fit the right price for us, so that we buy them with conviction. That is investing in great businesses, not just great businesses, but also the right price. And in that line, I already discussed Google 2 months ago, but I really wanted to update Google in our intrinsic value table to see what's the real valuation and to see that when perhaps the stock price crashes and it becomes really a good value, or to see maybe it is already now a good value. So we're going to update this template, but let's first discuss the business, the stock price targets from investors, etc. Just a small comment on stock prices, talking about opportunities. Usually, every business increases 50% in 1 year and crashes 30% from top to bottom tick down 30% and from bottom tick to top tick up 50%. That's the inherent volatility of an individual stock. And when looking at great businesses, if you understand them, if you have a correct valuation of them, then you can take advantage of those opportunities or allocate more of your new money into those businesses. And if we look at Google, we have seen it at more than half of what it is now just a year ago during the COVID crash. And I think also Seth Klarman bought here. Now it's much higher, but I'm sure of one thing, that there will be a lot of volatility. This was 26% down. Here we have had another 20% down, so a little bit less than 50%, but 2007 it was okay, 50% down, then it was up and down and stable parts. So not that volatile given the quality of the business, but still very, very interesting, and interesting to see how will this spike end up, or whether it will create opportunities or not in the future. When it comes to target prices, banks have target prices up to 3,000, the median is 2,400 low, perhaps someone didn't update because they usually update, so 1,400, but we are still below the median target prices. Let's just quickly do a business overview, because we all know what Google is, and there is the known part of Google and the unknown part of Google. We can talk about the unknown part of Google for ages, but why not just leave it unknown and as a positive upside that you get for free? If you want to learn about a business, the best way is to use the 10K form for US businesses, the annual report that was filed by Google, and you can see all the interesting things, the trading symbols, all you need to know. But usually it also has a great business explanation, risk factors that really help you in understanding a business. We are not going to go through all the details, but this is perhaps the nicest thing. Of course, Google search, access and technology for everyone, including YouTube, making money on advertising. You are paying 45% of the advertisement you watched or YouTube Premium goes to Google, 55% goes to me as you are watching this, so thank you for that. Then other bets also pursuing initiatives, similar goals, so part of metro area, etc., etc. But we all know what Google is and the ecosystem around Google. Then there are also the moonshots, trying to explore things that are really long shots, but you never know how it will end up. People thought we were crazy when we acquired YouTube and Android and when we launched Chrome, but those efforts have matured into platforms for digital video and mobile devices and the saver popular browser. So all those moonshots that you never know what will end up. On the Alphabet Investor Relation, there is a frequently asked question thread, and you can find a lot of questions. Does it pay a dividend? No, it is focused on growth, but this is also something that gives you a good overview of the business that summarizes it all. So Google services, ads, Android, Chrome, Google Maps, Google Play, YouTube, search. So they make money primarily through advertising, sales of apps, etc., etc. Also now YouTube Premium and YouTube TV. If you don't want to watch advertisements during my videos, then take YouTube Premium. Then we have the cloud segment, first time specially reported, with a very nice presentation recently by the cloud CEO. So what's the mission? Of course, develop cloud, and they show the huge business growth ahead. So more than double expected in cloud markets over the next 5 years. And they are a big player, of course, there. Then you have a detailed presentation of the cloud business, but the most important thing for me is the backlog and the revenues already there making money. So the backlog is exploding as all those companies that they have mentioned here are ordering and buying more and more, especially as more businesses are moving into cloud operations and there's strong revenue growth. So something that was small a few years ago is becoming bigger and bigger and the bigger part of Google. And you never know how will other projects, other bets like Access Fiber, Calico, Capital IG, GV, Verily, Waymo, and X, among others, develop, and when will reach 5, 10, 15, 20 billion in revenues. That's unknown. However, I don't think that is priced in, and you get all those things and other intelligent things that Google will develop for free. The key question with Google is, okay, the search, the traffic there, our relation to Google, the YouTube, will you go away from YouTube? For now, I don't see a reason why will I go away or why you should go away from YouTube, why we should go away from search or something like that. There is competition, but Google is getting a stronger and stronger mode. It's always tech, it's always uncertain, so I would never put 100% of my money in Google, but you have to see how this fits your portfolio. Let's look now at the finances and the outlook. At Morningstar, just a quick number overview. Price to sale is pretty high, 10, almost 9, but the forward price to earnings ratio is 34. 34, that means that the earnings yield is around 3%. 3% is not that much, but still interesting. And then on top of the 3%, what will determine your long-term returns is the growth that will come from Google over the long term, and that's something we'll use in the valuation. Also, as we said, great business, return on invested equity 19%. This is huge returns, and if they keep doing 19% on invested equity, that's also the return you have to expect over the long term. 3% earnings, 15% growth, then you are there at 19% in the long term. The net margin is high because they have a strong position, 22%, so all the numbers look great. Morningstar's target is still a little bit higher, but they usually adjust it, of course, as the stock price goes higher. But the 5-star price when this would be really a bargain is 1,500 through Morningstar. So let's do a valuation. We did just a quick valuation on free cash flows that are reinvested for growth. So I'm not going to take the present value of the cash flows, I'm just going to reinvest them for growth. And let's say that they grow at 15% over the next 5 years, perhaps a little bit faster, but let's say 15%, then slow down to 10% discount rate, terminal multiple 25, so a 4% cash flow yield, could be higher, we'll do that in the best case scenario, and the intrinsic value is 1.1 trillion. We compare it to the market capitalization 1.5 trillion, which would say that Google is a little bit overvalued for a 10% return that we estimated here. However, if we continue there, as I said, we have to delete because no dividends planned, but if the growth rate is a little bit higher on the cash flows, and then it slows down to, let's say, 15%, and the market is still exuberant with a terminal multiple of 30 for 3% dividend yield if they pay out all the cash flows, then the value in trillions is 2 trillion. So keep that in mind, this is the market capitalization I'm comparing things to. In the worst case scenario, let's say that they grow at just 10%, then 5%, and on the terminal multiple is just 20 for a great business like this, then the valuation is half of the current market cap. But if we put, let's say, 0.5 chance for the standard scenario, 0.25 for the best scenario, and 0.25 for the great scenario, then the intrinsic value for a 10% return is 1.2 trillion. Compare that to the market capitalization, and let's say that now the return expected from Google is 7-8% over the next 10 years. Of course, if they keep returning 20% on invested equity and reinvesting everything, then it will be even higher because the stock will go higher and higher. If we compare this here into the intrinsic table, the market cap now is around 1.5 trillion, the intrinsic value for a 10% return 1.1 trillion. So if it crashes 20-25%, you can expect a 10% return. Now we are at around 7-8% from Google, which is still great, still a great business, so nothing wrong with that. So when it comes to the investing thesis, I think Google is a great business, giving a high single-digit return, which is nothing bad. It's a great return, great business. Of course, you have to think that it can always crash 50%. There will be bad times with Google. There will be, I don't know, regulatory issues, as there are always. There will be competition, increased competition, more competition. So there will always be something, but you have to know, watch the business, and that's also what I want to do with this initial video now, especially on Google. Put it there, put it on my list, and then see how it evolves, and whether at some point it's a total bargain for me, also compared to other options. So you have to see how Google at these valuations fits your portfolio, whether you want to own Google for the long term, because that is investing. Do I like Google from the current perspective, and do I like to own it forever, no matter where the stock price goes? If it goes lower, I can reinvest some other dividends into it or some other income and then build on that. So that's the question, and how Google compares to your other positions. If we just check the comparisons, a lot of companies here are even more expensive than Google. Apple is a little bit more expensive than Google is now from a relative perspective. Asian companies are much cheaper from that relative perspective. But there is a lot, and you have to always compare it with the quality here. And you can download this in the template below, so feel free to do that. Also check the researches for related stocks. The premium version of this with my stocks and my portfolio is on my stock market research platform. Check that. Thank you for watching. Looking forward to your comments. Please click that like button if you enjoyed this video. Consider subscribing, and I'll see you in the next video.